think government bonds are expensive. Why do I think government bonds are expensive? Well, I think basically they're still being priced for the Armageddon situation that we were faced with over the last 2 to 3 years. Actually, looking at early 2013, sometimes it's difficult to remember how depressing the situation was even a year ago when we looked at the situation of the end of the euro, the collapse of the eurozone as an economic entity in that respect. So what happened over that period is that the safe haven status of government bonds, and the UK was very clearly put into that safe haven sector, drove yields down. It was only back in August and September of last year, 2012, when we were looking at UK government bonds, 10-year government bond yields at 1.4%. Actually, a really unattractive and historically unprecedented level of yield. We got there because the unattractions of other assets and the safe haven status of the UK government. What we're seeing now is some moderation of that. You look at the papers, you look at the media, the radio, the TV, the stories that were dominating the news 12 months ago about Europe are not there. Certainly not in terms of the economic terms. That is itself is taking some of the pressure off the factors that drove government bond yields down. So this is just a part of the normalisation, in my opinion, of government bond yields. So, as I mentioned earlier, our expectation is that government bond yields will rise during 2013, taking 10-year yields to above 2.75%. So that, from where we stand at the moment, will give you a negative return on UK government bonds. So your question was more general than that. How do government bonds stack up against other asset classes? Well, actually, I think they are a relatively unattractive asset class, that equities, high-yield bonds, investment-grade credit bonds will give better returns. I think I say that with the basis of looking for the longer term. I'm a long-term investor. I think our strategy at Royal London Asset Management, the fixed interest strategies that we pursued, is to focus on the long term. Get that right, you can live with some short-term volatility. So looking at the valuation of assets in a longer-term picture, I would say equities are the most attractive asset, high-yield bonds next, investment-grade credit, government bonds. Actually, within government bonds, I think conventional government bonds are actually better value than index-linked bonds. Despite the potential for inflation in the longer term to rise, I think the valuation of index-linked bonds, not just in the UK, but globally, but particularly focusing on the UK, are unattractive. Now, that's the easy part. The hard part is saying when is the best time to buy to increase exposures to those assets that can produce better long-term returns. And my problem with equities, for example, is that I don't think it's the right buying opportunity now. I think you're going to get better opportunities in 2013. So why is that? Well, put simply, those points I made a few minutes ago about Europe not being in the headlines, I don't think that's going to be the case during 2013. I think there are a lot of pitfalls that European politicians will have to face during 2013. The crucial one is, where is the long-term growth going to come from in Europe? Where will the growth come to reduce unemployment? Where will the growth come to cut government deficits? These are issues that are not being addressed. I think when the markets actually start to focus on these points again, actually that's when risk assets will fall in price for longer term investors. That will give you a good opportunity to buy for the longer term. But I think structurally, Europe in particular, and I could widen this to the UK, has some real big challenges to address. And therefore, I would be reluctant to say buy equities now for that longer term return. I think you will have better opportunities. The Royal London Asset Management have launched 2 global high yield funds in February 2013. The first one is a short duration fund aiming to generate a yield of about 5% on the assets. The second is a global high yield fund looking at the whole area of global high yield investment. So not just the short duration area, but the whole of the universe. And there we're targeting a yield of about 6%. I think just focusing on those yields actually highlights the answer to your question. Basically, investors are searching for return. They're searching for yield. And actually, as you look around the globe, there are very few opportunities to generate income. And I think high yield investment is one of those areas that is increasingly coming into the area review of pension funds. When I started investing in stock markets, there were basically three main assets: equities, bonds and property. Now there is a much, much wider scope for areas of investment. And I think increasingly global high yield will just be seen as an asset class like investment grade credit bonds, like government bonds, like property. So I think that demand will come from pension funds looking for higher yielding, higher returning assets. Now, what you have got to also consider is the volatility. And I think one of the attractions for global high yield funds is actually their comparatively good returns relative to equities. If you look at the last 10 years, global high yield has outperformed equities. But actually, their lower annual volatility. So how much can you lose or gain in a particular year? It's not that high yield bonds aren't volatile or funds aren't volatile, they are, but they are a lot less volatile than equity markets. So actually, for funds looking for higher yielding assets, higher yielding returns, but not wanting necessarily the annual volatility of equities, actually high yield falls into a really attractive space. So if you put it into the financial jargon, it's basically offering a very good risk-return trade-off. In terms of an optimal portfolio structure, it's offering some characteristics that are really attractive. That is, prospects of good returns, but lower annualized volatility, certainly than equity markets. So, in terms of why we think this is the way forward, I think increasingly investors will look global. I think increasingly investors will look to have higher yielding assets within their fixed interest portfolios. And I think the people that we've recruited, brought into Royal London Asset Management, with their global take on investments, are ideally suited to that environment. Well, I think actually this is one of the key questions for 2013. In my opinion, investors are being too optimistic, too relaxed, even too complacent about the threats that Europe will pose in 2013. One of the responses I gave earlier was saying, well, actually it's not necessarily the right time to buy the riskier assets, certainly equities, at the present time. And I think if you look at the bond yields that are prevailing in Spain and Italy, for example, I think that reinforces the point. An awful lot of good assumptions have been made about the abilities of these economies to finance themselves. Yes, Italy and Spain have got bonds away in recent times. And if you look at the fall in the spread, the yield premium over German bonds, that has collapsed. It's really come down. These bond markets have given great returns over the last 6 to 12 months. But actually, I think this dodges reality. If you look at Italy, Italy is a classic case in point at the moment. A lot of money has been made by buying Italian bonds over the last 6 months. But actually, on the ground, the economy is just not improving. Yes, government deficits are improving, but actually the underlying performance of the economy is poor. Again, let's look at Italy in a bit more detail. In a situation in which you have a single currency and countries come together, they basically come together at that one currency and that one rate. Italy in the past has been used to devaluing its currency as a way of getting a regular competitive advantage over its neighbours. It just can't do that at the moment. So what it has to do to be competitive is reduce its labour costs. So is Italy doing that? Well, simply no, it's not. In fact, it's going in the opposite direction. Italy is becoming more and more uncompetitive from a unit labour cost perspective. They can't dodge this ultimately. They can't devalue. They're not taking the internal reforms to change that. Yes, Monti has made some good progress. But actually, you now have to ask, will those reforms be continued? We're facing an election coming up in a week's time in Italy that is really crucial to Europe. If Monti does not form part of that government, the continuing to reform, I think there will be renewed questions about the ability of these countries to instigate internal reform, the ability of these countries to generate growth in the medium term. So I think, in answer to that question, actually we are coming up to some fairly important points fairly soon that I think will challenge the complacency. But going back to an answer I gave earlier, the core problem, not just in Italy, I focused on Italy because that's topical in terms of the elections, but in terms of those countries that came under pressure, the question still remains, where does long-term growth come from? Where you've got population stagnation, where you've got low productivity growth, where you've got leverage that has to be taken out of the system, where you've got some challenges perhaps to long-term growth rates globally, these economies are really under pressure. And I think investors will have to focus on that again in 2013. I'm not saying it's going to be a repeat of some of those really crisis periods that we felt in 2011, but I do think some of that complacency will have to be challenged, and that will give rise to volatility in markets. So we are certainly not out of the woods when it comes to Europe. I mean, I could widen this. You asked about Europe. I think you could widen it to also look at the US, where coming up fairly soon, 1st of March, is the question of the implementation of these mandated cuts. Again, I think investors are being very complacent about the impact that these cuts will have on growth, the cuts they will have on government spending, on real disposable income. So I think there are a number of hurdles that are really going to challenge markets over the next 3 to 6 months. So I think it's time to reappraise some of those easy assumptions, some of the complacency that has been built into markets.